Okay, so you want to be an options trader. You understand the basics, you know your condors for your butterflies, and you've got your account all set up with TD, Schwab, or Robinhood. Now the only question is, how do you get started? Or more accurately, when do you get started? Because while the stock market is technically only open for 6.5 hours, 5 days a week, a beginner could devote their entire day to watching tickers. But do you really have to? Isn't there a sort of prime time for options trading where you can maximize your profits without wasting your time? Well, you're in luck because there actually is a best time of day to trade options. And we're going to talk about why in this video. Thank you for watching this video. But before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. In recent years, options traders have cultivated a sort of mystique around themselves. Many people think of us as waking up at 4 a.m. to pore over charts and models, only stopping to get ourselves a fresh cup of coffee. However, if you spend enough time on YouTube, you'll find traders who claim to only look at their phones once or twice a day, typically in between boat trips through the Bahamas. So what's the right answer? Does options trading require constant, non-ending vigilance in order to pay off? Or can you set it and forget it while you go gallivanting around the Caribbean? Well, I can't speak for all the other options traders out there. I found a daily strategy that works for me, and I think it will work for you as well. A typical day on the stock market. Before I get into my own specific trading strategies, I think it would be beneficial to discuss the overall flow of the stock market. After all, there are very distinct patterns that, while not carved in stone, tend to set the ebb and flow of your typical market day. Those early birds I mentioned? They're normally up so early to check out pre-market trading. This period lasts from around 4 a.m. to 9:30. During this time, the market experiences much lower trading volume since it's outside regular trading hours. Only certain traders, like institutional investors, tend to participate pre-market because price movements can be so volatile. That said, some investors think they can accurately gauge the day based on what happens in pre-market. The opening of the market at 9:30 a.m. Eastern Time is often accompanied by a surge in trading volume. You see many traders place orders before the market opens, which are then executed at the bell. This period can also be extremely volatile as investors react to overnight news and the global market trends. However, after the initial flurry of activity, the market often settles down and trading volume typically starts to decrease. Of course, there are usually a few dozen stocks that will enter a tug of war between bears and bulls, which is where a lot of day traders make and lose their money. Lunchtime is typically accompanied by a lull. However, keep in mind that not all traders are in the US or even on the East Coast, so a lot can happen if the conditions are right. Trading volume usually picks up again in the late afternoon as traders and investors make final decisions and adjust their positions before the market closes. The last hour, often called power hour, is usually accompanied by a spike in volume similar to the opening. This too can be a decent time for day traders to take profits. Finally, you have after-hours trading, which lasts from 4 p.m. to around 8 p.m. As with pre-market, this is generally typified by lower volume, high volatility, and moves by institutional investors and high net worth individuals. My prime time is the first hour. In the intricate world of options trading, timing is not just a factor, it is often the linchpin of success. While we typically fit the definition of day traders, our strategies, and therefore our timing, can often be very different from your average stock flipper. For instance, regular day trading focuses on quick, short-term price movements and is heavily reliant on technical analysis, whereas options trading involves a more varied range of strategies. This not only requires a deeper understanding of option-specific concepts, but it means volatility can be our friend as well as our foe. Understanding that, let's go back to what I said about the first hour of trading, from 9:30 to 10:30. First, remember that the start of the trading day is almost always accompanied by an influx of trading volume. In fact, on a typical day, more shares trade hands in the first hour during any other. The spike is attributed to the accumulation of orders placed after the market's previous close. Processing these orders at market's opening often leads to substantial price movements, thereby increasing overall volatility. Next, you have liquidity and its various advantages. With an increased number of shares being traded, the market experiences significantly enhanced liquidity. This is often seen as beneficial for options traders, as it leads to narrower bid-ask spreads, thereby reducing the cost of executing trades. Third, you have the impact of overnight news. Developments in global markets, economic announcements, or company-specific news can create an imbalance in buy and sell orders. This often results in stocks opening at prices significantly different from their closing prices the day before, creating potential opportunities for options traders. As a dedicated options trader, I utilize several different strategies during the golden hour. For starters, I can capitalize on the immediate price movements by positioning my trades just as the market opens. This is also the perfect time to implement strategies like straddles, strangles, reverse iron butterflies, and reverse iron condors, which can be particularly effective at this hour due to the expected price volatility. If that sounded like a bunch of gibberish to you, don't worry. I'll explain them in a bit more detail before moving on. A strangle is an option strategy where you hold a position in both a call and a put with the different strike prices with the same expiration date. Typically, the put strike is below the stock price and the call strike is above the stock price. This strategy is ideal when you expect a significant price movement, but you're unsure of the direction. The straddle, which is similar, involves buying a call and a put option of the same underlying stock, strike price, and expiration date. This strategy is also good when you feel a stock will experience significant volatility, but again, you're unsure of the direction. The potential for profit is unlimited, while the maximum loss is limited to the total cost of both options. The reverse iron butterfly is a much more complex strategy. It involves selling an out-the-money put and call while simultaneously buying an at-the-money call and put. In this case, all of the options have the same expiration date. Finally, a reverse iron condor consists of one set of out-of-the-money put and calls alongside a different out-of-the-money put and calls. All options have the same expiration date, allowing you to profit significantly when the underlying stock makes a large move. In this case, the maximum profit is capped at the difference between the strike prices of the short and long options minus the net premium paid to open it, while the maximum loss is just limited to the net premium paid. Let's take a look at an example. Hey guys, Options Trader Chris here with my trade of the week. On Tuesday, I opened a strangle on SPX for Wednesday. At the time, the index was trading around 45.50 to 45.55. I bought a 45.65 call at a price of 273 and a 45.30 put for 681. My total cost to open this position was $962. On Wednesday, I needed the S&P to either move down below 45.20 or above 45.75 in order to break even on this position. The index hadn't been moving much the past 2 weeks, so my intent was to look at the futures and how it opened and then make a decision at that point whether to keep this trade as is or to open new short positions to make it an iron condor or even a butterfly. Now, leading up to the market open on Wednesday, futures indicated things might be trending up. The latest CPI numbers had come out and it looked pretty good, but not much had moved stocks in a while, so there was no guarantee stocks would respond favorably. Now, markets opened Wednesday and the S&P 500 immediately shot up to 45.85. The market price of my call shot up with it, so I decided to take advantage. I sold this contract for a price of $18.10. Now, at the end of the day, the put expired worthless, and subtracting out my original cost to open this position, my net profit on this single strangle was $855 gain. Not a bad day's work. Now, I do want to pass on a word of warning about golden hour trading. That is, you should always be wary about opening multi-day or multi-week trades during this time. Due to the added volatility, prices can change significantly in just a short amount of time. If it moves in a direction you're betting against, you could end up holding a very large and very expensive bag. So what's the second best trading time? I tend to make most of my trades nice and early, but that doesn't mean I pack up and call it a day. In a lot of instances, there's plenty of money to be made during power hour too. If you remember, this is the last hour of trading between 3 p.m. and 4 p.m. Eastern Time. Again, there's typically plenty of volatility for us to capitalize on, as this period witnesses significant trading activities from institutional investors. Because these investors are looking to close their positions for the day and set up new ones for the following day, they can purchase and unload huge amounts of stock in a very short time. This can create notable movements in stock prices, presenting unique opportunities for option traders to capitalize on. In conclusion, finding the optimal time for options trading can be a crucial factor in your success. Still, in my opinion, the golden hour offers the most opportunities due to the increased trading volume, enhanced liquidity, and the impact of overnight news. However, the power hour should not be overlooked, as it also experiences significant volatility in trading volumes, especially from institutional investors. Remember, it's crucial that you approach options trading with a well thought out strategy, a clear understanding of the risks involved, and an awareness of your own risk tolerance. Whether you choose to trade during the golden hour, the power hour, or another time, always ensure your trading decisions are informed, deliberate, and aligned with your overall investment goals. In the world of options trading, there is no one-size-fits-all approach. Each trader needs to find the rhythm and strategies that work best for them. The key is to remain disciplined, continuously educate yourself, and stay adaptable to market changes. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.